Good afternoon and welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. And let's get to the BNN Bloomberg newsroom, take a look and see what's going on there. Shares of TELUS are seeing some pressure. The telecom giant says longtime CEO Darren Entwistle will retire in June and is named former CIBC chief Victor Dodig to take over as CEO. TELUS also reported fourth quarter profit and revenue that came in below what analysts were expecting. There was also a steep decline in mobile phone additions, with that metric missing estimates. Fourth quarter profit and revenue came in above expectations for Bombardier. The aircraft manufacturer is coming off a recent $1 billion plus deal with Vista, and more than 40 aircraft will be going to Vista over the next decade. Looking ahead, the company forecasts more than $10 billion in revenue while delivering more than 100 planes. Despite currently not facing any U.S. tariffs, the upcoming CUSMA negotiations could have a significant impact on the company. Brookfield shares are moving higher, up about 1% at this point. It's a rough day all around for the market. So total assets surpassed expectations in its latest quarter, while profit rose compared to the year before. The money manager says results were driven by record earnings from its asset management unit, as well as growth in its wealth solutions business. Brookfield's operating segments also generated higher cash flows. On the markets, in for a rough ride right now, despite strong earnings reports from several major companies. Our next guest says this is due to a shift away from the traditional beat versus miss system and toward one that focuses more on credibility and forward certainty. To explain this and break it down for us, we're joined by Martin Pelche, Senior Portfolio Manager with Trivest Wealth at Wellington Altus Private Counsel. Martin, thanks as always for joining us.
You betcha.
Okay, so we're moving away, and you say we're heading towards a system that focuses on credibility and forward certainty. What do you mean by that?
Yeah, I saw a chart the other day showing the World Uncertainty Index and it being an all-time high, significantly higher than any other period going back to 1995. What's really interesting is that we have this high level of uncertainty and markets are testing new highs. And you're seeing that being reflected in stock moves in this earnings season here. Those who've been missing, for example, or those who have provided guidance uncertainty, maybe some margin pressure, or have a trust us or payoff comes later, been hit pretty hard. High single digits, low double digit sell-offs. You know, you got companies like Charles Schwab, Raymond James, Netflix, Shopify, Allied Properties, and a whole bunch of others that haven't done very well because they haven't addressed that. And for those who have provided a clear path between capex and return, providing that peace of mind, have done well. So you've got Meta, NVIDIA, Broadcom, Intact Financial. Those companies have done well. And so it's more of a certainty and clarity and credibility vote of confidence than the actual numbers that we've seen earned over the last 3 months.
Now, do they not carry some weight, though, still? I mean, a good earnings report has got to be worth something towards credibility.
Yeah, the numbers and the fundamentals certainly do matter. But as you know, markets are forward-looking, and they want to get some comfort around that forward outlook. For example, software as a service have been highly disrupted by AI. And so despite having some strong numbers, their business model is in question. And maybe it's been oversold. I don't know. But that uncertainty is hit the sell button first and then ask questions later.
So are people finding certainty in precious metals right now? Is that what's driving those prices up?
Yeah, and so I mean, I think what you have to do is you have to get some help from a portfolio manager that goes beyond relationship management. So you got to look at segments of the market that are going to do well, driven by underlying macro support. And commodities have strong macro support in regards to sovereign debt risk, fiscal spending, deficit spending, money printing, and debasement. And so there's a global race, maybe an arms race per se, to accumulate commodities and shore up inventories globally. So that's copper, that's gold, that's uranium. And we've been participating through owning the high caliber companies or high caliber producers. So in copper, BHP, we like. In gold, we own Agnico. And uranium, we own Cameco.
Okay, and I just want to, did you miss silver or did you look at what it's doing right now? It's down another 10% at this moment. Is that one of those ones that there's uncertainty?
Yeah, there's so much uncertainty, so much speculation. We did own silver and we profited handsomely for our clients, but it became too speculative of an asset and way too volatile. I wrote about it in my post column this week. And, when you're seeing 10% plus or minus 10% daily moves, that's not really an investment. It's more of something to bet on. We're looking at long-term commodity positioning, long-term supply fundamentals and demand strength on copper, on gold, and even uranium, and playing the AI build-out and the resources that's going to be required to support that.
And you mentioned about energy, oil. Does that fit in anywhere there? What are you looking at with that?
It does, and it's really interesting to see the divergence of Canadian oil companies or U.S. oil companies to the underlying oil price. We made a call that we were expecting lower oil prices mid-year last year, and so we reduced our energy exposure. It was the right call on oil, but it diverged. The companies did quite well, and they're paying out strong dividends despite lower oil prices. And it's nice to see the support in that sector. There still is 1.5 million barrels a day of surplus capacity from OPEC. I personally think that you're going to see a ceiling on oil prices, especially ahead of U.S. midterms, as it's in the U.S. administration's best interest to keep oil prices and gasoline prices down. But I think investors in oil stocks are looking past that. And if you look out a year or 2 years from now, there's a potential for a supply shortage if demand continues to grow. And that means some good opportunities in the energy space. And so we're keeping a close eye on it, whether we want to dip our toes back into the sector or not.
All right. And I guess pretty much 100% certainty, government bonds, where do they fit in for you?
Yeah, we don't own them. And I mean, if you look at the value of your dollar, it's 75 cents from pre-COVID. You're looking at, I think someone told me the other day, it's like 30 to 50% of the money that's been generated has been printed since COVID. I mean, that's a big number. And if you have debasement, the last thing you want to own is a government bond or debt, because they're going to inflate that away. And so you're going to not do yourself any favor. So you want to find alternative strategies. Be careful on private credit, because that's experiencing a lot of difficulties right now. But we're using structured notes as a replacement with deep downside barriers, and that's working very well for our clients.
And what about bonds for companies? Where do you stand on that?
Yeah, corporate bonds. It's interesting that you're seeing yields on some corporates better than U.S. Treasuries like Microsoft. You saw that big Google deal the other day. Mm-hmm. So there's a strong demand for corporate bonds, which is good. We want to see that liquidity. It's a good sign for the broader markets that bond markets are still functioning. But there's probably more safety and more benefit in owning bonds by corporations than by governments at this moment, which is we haven't seen that before in a long time.
All right, we'll have to leave it there. Martin, thank you as always for joining us.
You bet. You take care.
Martin Pelletier is Senior Portfolio Manager with Trivest Wealth at Wellington Altus Private Counsel. Well, the U.S. House has voted to override Donald Trump's Canada tariffs. What does that mean? We'll have more on that after the break. Well, the U.S. House of Representatives has voted to rescind U.S. President Donald Trump's tariffs on Canadian goods in a 219 to 211 vote. 6 Republican lawmakers joined the Democrats to get that through. It's a resolution that would see to end tariffs that Trump imposed on Canada last year. Joining us to sort it all out, the legal, the economic implications, some tax implications, Lachlan Wolfers, Global Head of Indirect Taxes and Global Head of Data for Tax and Legal at KPMG Canada. Lachlan, thank you very much for joining us.
Great to be with you, Roger. Thank you.
I think there was some optimism about what happened yesterday, but is there any reality to what happened yesterday? Will it go anywhere?
At a surface level, Roger, I think people would look at this as being mere symbolism in the sense that President Trump does have a right of veto, even if this is passed ultimately by the House and the Senate. But I think the bigger picture issue here is actually what lies beyond this. And in particular, if the US Supreme Court finds that the IEEPA tariffs, they're the emergency tariffs that were imposed on Canada in response to the perceived fentanyl crisis, if they're found to be unconstitutional, then President Trump's response to that, beyond an initial period of 150 days, would likely require congressional approval. So what this really indicates here is that if those tariffs are found to be unconstitutional, for President Trump to reimpose those for the longer term, he may have some difficulty securing the support from his own Congress to do so. That's the first aspect. And I think the second aspect that we see is, as we head into the review of the CUSMA agreement towards the middle of this year, again, if there is a fundamental change to that agreement, that will require congressional approval as well. And I think what the US Congress is indicating is that perhaps going and imposing tariffs on their closest and nearest trade neighbours, being Canada, is not something that's being well received by lawmakers in the United States.
Especially when you see 6 Republicans knowing they're going to draw the wrath of Trump going against it. It says a lot about the pressure they must be feeling in their areas and where they are. I can't remember the name of their wards. I want to say wards, but not wards, where they represent.
So I think that's right, and I would expect as we move closer towards the midterm elections later this year, a couple of things are likely to happen. Firstly, you're more likely to see some of these congressional lawmakers make decisions on their own rather than necessarily following the party line because of obvious concern and pressure about re-election. And then I think the second component is that I think heading into the midterm elections, there's going to be a very real focus on ensuring within the US that tariffs are not unduly impacting the cost of living for your average American. So I think that pressure is only going to intensify as we head towards those midterm elections later this year.
Okay, let's do a couple of hypotheticals, put you on the spot here. What would happen if the Senate suddenly says yes to this, a 2/3 vote, Trump couldn't veto it? We know that's not going to happen. What kind of tax repercussions and legal repercussions would happen for Canadian companies that had been paying, or either the Canadian and American companies that have been paying these tariffs?
Well, I think everyone's waiting. So firstly, these tariffs that are the subject of the decision, the congressional vote yesterday, concerned the IEEPA tariffs, the emergency tariffs, and not on the sectoral tariffs, those on steel and aluminum. Those IEEPA tariffs in form are quite high, but in substance, because of the exemptions that Canadians enjoy under the CUSMA agreement, roughly 85 to 90+% of products are not subject to those tariffs. So the first thing is to say that the true impact of this is not quite as profound, certainly, as we're seeing with the sectoral tariffs. But in direct answer to your question, if the tariffs are ultimately found to be unconstitutional by the US Supreme Court, there will be a flurry of refund claims that are lodged by businesses, and we've seen many of them take action to protect their refund rights in advance of that. My best guess, in the event they are found unconstitutional, there is a power that the president has to impose tariffs in substitution of up to 15% for 150 days. And then beyond that, President Trump would likely have to rely on the imposition of more sectoral tariffs or get congressional approval. And that's where the options start to narrow, not to mention that the 150 days that we're talking about probably leads you right into the middle of the midterm election period. So it's going to be more challenging. And I think if we stand back from this for a minute, I think this is informing the approach that Prime Minister Carney and the Canadian government's adopting to this, which is, in essence, we've got to stall for time. Time is our friend here. The longer this goes on, the more difficult it will be, not to mention the potential for the US administration to get distracted by some other crisis or some other decision from a tariff perspective, focusing on a country other than Canada.
Now, and with SCOTUS, we've been talking about this I think since probably the beginning of the year, that they could release today, and then today. Any indicators as to why it seems like they're holding off, or have they just not reached a final conclusion?
So I think the first thing is to recognise that the time period for a decision from the US Supreme Court is basically any time. I think it's from February 20th is the next date for a decision that could potentially be released, up and through to the middle of the year, where they reached the end of the current law term. This is a normal kind of time frame. What I would say is this, based on experience, is the longer we wait, the more likely it is that those tariffs could be held to be constitutionally valid by the US Supreme Court. The reason being is, if they had made their minds up to say it was unconstitutional, then you would typically expect them to release a decision more quickly, because they're obviously aware the tariffs are still being collected in the meantime. So I think it's too early to judge which way it's going. This is a normal sort of time frame the US Supreme Court has. They only decide cases of importance to the American public. Okay, well, we'll have to leave it there. Lachlan, thank you very much for joining us. Great to be with you. Thanks so much, Roger. Cheers. Lachlan Wolfers is Global Head of Indirect Taxes and Global Head of Data for Tax and Legal at KPMG Canada. Well, Shopify gets an upgrade from TD Cowen. We'll tell you why after this. Welcome back. We are going to take a little look at the markets at this moment. We'll head to the TSX, and I don't think you want to see it, actually. It is down more than 2% today. Virtually every sector, I think, is taking a hit. I was pulling it up here and taking a quick look at where we're at with it. Oh, my typing skills. I got fat fingers. Hang on one second. There we go. Just when I looked last time, every sector was taking a hit except for... we could see utilities, consumer staples, comms up, but the rest all in the red. Infotech index down 6%, more than 6% right now. So it is a rough day for the markets, but we're going to take a look at a few other things. And we've just had a little technical change there. I'm just trying to, where are we going on this one next? I'm going to ask that directly. And this one's about, I know the Super Bowl's come and went, but the halftime performance, that's what they're talking about. This year, millions watch Bad Bunny take the field in San Francisco. On Sports City, Randall Williams takes us behind the scenes of the show to see how it's made, who picks the artists, and the history behind the 13-minute performance.
They're setting up for the Apple Music Super Bowl halftime show right behind me. Bad Bunny is about to hit the stage.
I'm Randall Williams, a sports business reporter at Bloomberg News, and I'm taking you inside the world's biggest, flashiest, and most expensive sporting events to answer one question. How did sports become this big of a business? We know all about the game, but let's face it, sometimes the performance outshines the sport.
What's your favorite halftime show performer ever?
Prince, J-Lo, Beyonce, but yeah.
Shakira.
Bruno Mars. Michael Jackson, man.
In the 80s, the Super Bowl halftime show had a combination of pop acts and marching bands that often featured HBCUs. It was respectable, and it was safe. But everything changed when global icon Michael Jackson took the stage and transformed the show forever. After Jackson, the NFL booked dozens of stars like Patti LaBelle, Diana Ross, the Blues Brothers, Aerosmith, and more. But at times, the event fumbled. The 2004 show had the infamous wardrobe malfunction. A decade later, the league's mishandling of Colin Kaepernick's protest caused artists like Pink, Cardi B, and Rihanna to decline performing. Patriots owner Robert Kraft had seen enough. Kraft organized NFL Commissioner Roger Goodell for a meeting with Jay-Z in January 2019. The meeting resulted in a partnership between the NFL and Roc Nation, handing halftime show entertainment to Jay-Z's company. Shakira, J-Lo, and The Weeknd put on great shows. But in 2022, when Dr. Dre, Snoop Dogg, Eminem, Mary J. Blige, and Kendrick performed, the Super Bowl halftime show was officially back. That performance led to Apple Music replacing Pepsi as the halftime show sponsor, reportedly paying $50 million for the rights. There's still one question we haven't answered, though. who is doing the booking? Is it the NFL? Is it Roc Nation? Both? Roger Goodell says it's Jay-Z's call.
And sources tell me there is no league wish list or backroom steering. Jay picks up the phone and calls Rihanna, Usher, and this year, Bad Bunny.
Benito Boy! I love it. We absolutely love him.
Bad Bunny is about to take over.
It was Bad Bunny's first time performing in the U.S. in over a year, after skipping the U.S. on his world tour out of fear ICE would target his fans. He returned with more eyes on him than any artist on earth. See, in the NFL, even the intermission is monetized, politicized, and globalized.
After all that controversy, the Benito Bowl became the third most watched halftime show of all time.
This is Sports City.
And that was Bloomberg's Randall Williams. We'll have more coming up after the break. All right, time to take a quick look at the markets and see some of those who are struggling right now. Restaurant Brands International on their earnings today, they are off about 5.6% on the results for the Q4 mix, shall we say. And TSX overall having a rough day. But we're going to take a look at a few of the other markets. First, we're going to do some headlines and talking about the earnings from the parent company of Tim Hortons. They are struggling, as we mentioned, underperforming in same stores for Popeyes and Tim's. Okay, let's move on now to the Mullen Group. They are off about 10% right now. That's because of the Canadian trucking company and logistics company posting a drop in profit, missing estimates. Mullen says it is operating in a soft economy with overall demand remaining below previous levels. One bright spot, however, is the company beat on revenue driven by acquisitions. How about a bright spot like a Sun Life, for example? It is at a record high, up nearly 6% after the insurance company reported revenue in its most recent quarter that exceeded estimates and also posted underlying profit that beat expectations. The quarter was boosted by strong performance in its Canadian and Asian segments, as well as improvement in its U.S. unit and wealth management business. And now we'll go to the markets. You can see what a rough day the TSX is having. Allied Properties down 7%, Global Inc. down 12%. There are some big hits. Shopify off by 8.4%. You can see overall TSX down by 2.2%. South of the border, things are not much better. Everybody in the red down there. The Nasdaq bouncing back a little bit. That's a relative statement. Off by 1 3/4. It was down by more than 2 at 1 point. Okay, let's head to downtown Toronto, where the 2026 Canadian International Auto Show is kicking off this week. It's Media Day, and that means it's free for media. Andy's happy. He's down there right now. It is one of the biggest events around. Andy, you've had a chance to look at some of the cars. Who are you going to be talking to as well?
Yeah. Later on, actually, we're going to be talking to the Auto Dealers Association. It's interesting, just researching this. Apparently, there was an era, Roger, when they literally would park a car behind your car, a trade-in, get you into the office and just wear you down. There would be a closer who would wear you down and you would just have to haggle for a car. I think those days have gone. Some people apparently love the haggling for a car. But anyway, we'll be finding out what is ahead for the auto dealers. Of course, they make so much money off insurance and finance. That's a big source. Apparently more and more are making money storing tires for the winter. So it's interesting. It'll be interesting to hear about the sales channel. because we talk about the manufacturers an awful lot. Walking around, one thing has struck me, not that much ballyhoo about electric cars or hybrid cars. They are here, of course, but it looks like the sales have been disappointing, and the car companies, we've seen huge write-downs, Ford, Stellantis, taking huge write-downs. They were over-optimistic on the electric vehicle and hybrid vehicle potential. But it's good fun, and the cars are beautiful. I mean, they are things of beauty in terms of the technology in them, but as you know, if you bust a window now, it can cost you hundreds of dollars to fix the sensors, etc. Roger, you're more of a vintage auto guy.
That might be an understatement, I think, Andy. Yeah, I like my cars from the 90s. Okay. You know what? The closest I had to the closest I had to a new car was when I bought one in 1998. So it was from the same decade that we lived in for 2 years. Other than that, no, I drive the old ones. They wouldn't like me at a new car dealership.
The first car my wife and I had was a Volvo that was kind of a bachelor car with a souped-up engine, black on black, and it was amazing. But anyway, we switched to the minivan after that. Used, of course, needless to say. Roger, anyway, I mentioned Stellantis, and of course they've been in the firing line from the federal government because they said, oops, we're moving production of that Jeep from Brampton, Ontario to Illinois. So we got a chance to catch up with the president of Stellantis Canada.
It's an interesting time for the automotive industry, but for Stellantis in particular, I think Brampton is a hot topic, and it should be a hot topic. It's an important topic. There's many Canadians that have depended on that location, and it is something that factors into our future. It's something we're working very hard to figure out the long-term sustainable future of.
So that plant will produce cars again?
Well, I can't announce anything today, but I can tell you that we are working proactively with our government partners, with Unifor, to find solutions that meet the needs of the Canadian public today. That means that we find solutions for the tariff situations that have been imposed, where electrification is going. We want to find a sustainable option for Brampton.
Was the move of that product to Illinois because of President Trump's tariffs?
It was because we were on an operational pause as we were looking to figure out what the future was going to be here, and the timing just didn't work, and now we're working on what the next product could be for Brampton.
Right, because it's 3,000 jobs roughly.
Well, right now we have a number of people that were on layoff and continue to be on layoff. We're trying to do what we can for those employees that are currently on layoff. We've extended benefits, et cetera, to make sure that they're taken care of as best as possible. And we're working on that next solution to get as many people back to work as we can.
On a more cheerful note, you're still making cars and minivans in Windsor, Ontario. We're looking at one here, this one, the famous Caravan, and then in the distance there, the Dodge Charger. You just were ramping up production of that one last year, but I know, so it was a low year, but you still made 160,000 vehicles in Brampton, in Windsor. Sorry.
Absolutely, we're actually only one of the only OEMs that actually made more cars in Canada than the previous year, and we're going to do that again this year. And so as we ramp up the Charger, which is an exciting new vehicle, North American Car of the Year, that's going to add volume there. I think many people know, and we're announcing today, that we've added the third shift in Windsor, which will go live this upcoming week, and we've actually already now hired 1,700 new Canadians in Windsor to build these cars.
That's good news. I probably should just loop back. The federal government making threatening noises. From the reports I've seen, Stellantis got just over $200 million for expansion, and they're saying we want some of that money back. Can you update us on the negotiations?
Yeah, well, I can say we're having productive dialogue with the federal government, and that's not to avoid the question. The reality is that we want to build cars in Brampton. We've been in Canada for 100 years. We've been making cars in Canada for 100 years, and we want to continue making cars in Canada for the next 100.
The Prime Minister just announced the outlines of a new auto policy, and one of the salient features would be people would face tariff pressure if they weren't making cars in Canada. They want to bring in vehicles from outside the country. What is your reaction initially? I know you don't know the details.
Yeah, the details need to come for sure to fully kind of answer the question, but anything that protects Canadian industry and Canadian auto production, I think, is a positive move in the right direction. For many years, it's been more cost effective to import cars into Canada than it is to make them here. And obviously, we've been heavily invested in this country, and we want to make sure that we can continue to do that well into the future.
Why has the cost base been high in Canada?
Well, it's a high-cost country, just generally speaking. This is a first-world country, a great economic country, and has certain advantages to why we would build here. We have great manufacturing, great people, great healthcare situation, so it makes a lot of sense to make cars in Canada. The issue of there's some lower-cost areas in the rest of the world
AKA Mexico.
Yeah, where competitors have stationed themselves, and so we've had a more balanced approach to this, and we want to continue to have a more balanced approach to this.
Just tell us about one good news story. You're keeping more than 600 researchers and developers of drivetrain, including electric drivetrains, in Windsor.
Yep. Yeah, well, I mean, our investments aren't just limited to the production side. So we have research and development facilities in Canada. We've added more than 600 engineers over the course of the last year or so, and we're going to continue to double down on that. Canada is a place where you can get great people, well-educated, and really can lead us to the next generation of vehicles for Stellantis. And that's not just Canadian vehicles, but global R&D.
I mean, that's interesting. More than 600 researchers and engineers. And of course, the intellectual property will go to head office because it's not a Canadian company, but it's still a lot of high-paid jobs.
100%. Yeah. We are fully focused on where we can enact investments in Canada that are going to pay off for Canadians, but also pay off for our global footprint.
What about the Chinese cars coming in? I know it's a bit of a red herring. It's going to be only about 4 or 5%, and they're going to have to build a dealer network and stuff. But what was your reaction when you heard the federal government was going to allow in up to 49,000 Chinese cars?
It's something, again, we need to know more about where this is going to go. Obviously, they've talked about limitations to that, and that it needs to meet North American or Canadian safety standards, etc. I think it's something we need to be pragmatic and thoughtful about. There's a lot of things that come with it. Like, are we on the same competitive footprint in a market economy, non-market economy? Are we on the same competitive footprint in terms of access to markets and the investments we need to make here in Canada? And if we're on the same competitive footprints, like, competition's a good thing. The question is, are we on the same competitive, stand?
And what could Canada do to bring down costs? I know that, as you say, we're a first world country, hard to compete with Mexico in those terms, but are there simple things that Canada could do?
Well, I think choice is a great leveler of cost, and so providing more options for Canadian customers creates more competitive options. And that doesn't mean needing to go to China. As an example, electrification is a big part of our investments in Europe. There's vehicles and brands that we have there as a constellation of brands, over 14 brands within the Stellantis portfolio that could meet the needs of Canadians. And how do you grease the wheels for that to happen? That is accepting UNECE standards. Yes. And allowing that to come over, and without having to do a whole bunch of redevelopment and add cost.
Yeah.
And so can we bring more competitive products, especially that meet the EV needs of Canadians?
Yeah, but I meant the cost as a manufacturing base. Is there anything that springs to mind to bring that?
Well, it's volume and synergies, and so you need the volume to get the cost down overall. The tariff situation complicates that scenario, but we need to think about, is there other market opportunities for Canadian manufacturers to ship to as well? And so those are things that maybe hadn't been thought of in the past, but those are things that are coming into all of our considerations now.
Just one last question. I've heard, and of course it's going to vary, that you need to have about 200,000 volume in a plant to really make it work. But you're not at that, so you're not manufacturing fully at the economical scale in Canada?
Yeah, well, the more you're utilizing the plant, the better the costs. There's no questions about it. And so this is where when we think of Brampton as an example, the more that vehicle that we eventually put there meets the needs of Canadians and meets the needs of export markets for us here and gets to the volume standards there, we can bring costs down. And so that's why it's so important to pick the right vehicle with the right cost structures so that we can get going there.
That was our conversation with the president of Stellantis Canada. Right, let's take this Jeep Gladiator for a ride. Whoa! Oh my goodness. Oh my goodness. Oh, I'm liking that traction. Oh, torque.
It's actually in his contract that he always has a driver, usually a president preferably. Okay, a vote in the U.S. House of Representatives is signaling a growing anxiety over the White House's economic agenda. CTV's Jeremy Sharon will be here with the latest on that after the break. Key vote in the U.S. House of Representatives is signaling a growing anxiety over the White House's economic agenda and tariffs placed on its number one trading partner, us. For more on this, we're joined by CTV's Jeremy Sharon. Jeremy, thanks for joining us. We saw that vote. It took some Republicans to do it. Is it going to go anywhere?
Roger, I think at this point, it is more of a symbolic vote than something that is going to have a tangible impact. That's because, as you've touched on, Republicans sided with the Democrats to get this bill through the House. But it did not meet a threshold that is required for it to be, free of a veto power that the president holds. So you need to get 2/3 support in the House for it to be veto-proof. That didn't happen. That means this bill will now move to the Senate. Even if the Senate passes it, then it goes to the president, and ultimately he would either sign on it or, more likely in this case, veto it. And for that reason, it is not likely to actually impact the tariffs that have actually been imposed. But it does, signal that there is growing pressure on the president when it comes to, lack there of support for his policies, even from within his own party. We're seeing now some Republicans being willing to publicly oppose his tariff policies. Of course, here we're talking about the IEEPA tariffs, or fentanyl-related tariffs here in Canada. They were imposed early on in the trade war. 35% tariffs on non-CUSMA compliant goods, 10% tariffs on energy products. They're the same tariffs that are at the Supreme Court right now. The Supreme Court will be at some point issuing a ruling. We're waiting on that ruling as to whether or not the imposition of these tariffs was legal or not. And so, Roger, I think more than looking at the immediate impact of this vote, in that it won't, reverse these tariffs or force the president to remove these tariffs, but it does add to the pressure, the mounting pressure and opposition to his trade policies. And all of that is important at a time when Canada is going into CUSMA renegotiations, right? And so if he's facing more and more pressure to back off on some of these tariffs while we are looking to renegotiate the trade deal, it could help Canada even a little bit in these negotiations.
And we're almost out of time, but have we heard a response from the president or from our prime minister?
Nothing from our side, from the Prime Minister, but we have heard a response from the President, who was not at all a fan of this, taking to Truth Social to say that Canada is one of the worst partners to deal with when it comes to trade, and that they are bad at the northern border. He is clearly not a fan of this, but that is an indication, Roger, that he's watching these things closely. He's watching the votes in the House. He's watching what's happening at the U.S. Supreme Court, and so he's paying attention.
All right, we'll leave it at that. Jeremy, thanks as always for joining us.
Yeah.
That was CTV's Jeremy Sharon. Well, Shopify gets an upgrade from TD Cowen. We'll tell you why after the break. TD Cowen has upgraded Shopify from a hold to a buy. Investors, though, not agreeing with that right now. The stock is under pressure. You can see it's off for the day, 7.6%. It's off for the year, too, 16% right now. Let's bring in John Shao, equity analyst at TD Cowen, on why he's liking this. John, thanks very much for joining us.
Thank you so much for your time.
Okay, so what do you like about this? Why the upgrade?
Yes, we upgrade Shopify based on what we consider a rare combination of strong beat and raise quarter, solid business fundamental and outlook, and stock down 30% year to date. So that decline largely reflects investors' concern around AI disrupting software names. But we think at the end of the day, Shopify is going to become a net beneficiary of AI. And from a valuation perspective, it's basically at the trough levels. Historically, Shopify stock had made three major weaknesses and since 2022. And when that happened, the stock usually rebounded later with somewhere between 30 to 40% return. And in terms of the business fundamental, it's still the industry leader and the e-commerce infrastructure provider with high sustainable growth. So that gave us the confidence for upgrade because this is still a high quality business, but valuation is making a lot of sense at this point.
All right. I was trying to find the quote from the president about AI in 2026. He said essentially this was the year. What are they doing that gives you the confidence when it comes to the AI? How do you see them incorporating it?
Yes, there are two parts to that question. That's a great question. Internally, I believe Shopify is using AI to improve their margins, to improve their efficiencies. That's going to support continued margin expansion, free cash flow expansion down the road. So that's the internal use case. Externally, they have something called Sidekick, which is basically an AI system, AI agent helping merchants to run their business, give feedback, build their storefront. And that's one of the features already Shopify's been selling, already been providing to their customers. It's also been one of the biggest selling points to attract new merchants. So yes, they are using AI, both for internal application and external from a customer attention perspective.
And do you feel they have a grasp on AI and how to implement it?
Yes, because this is a company that, Shopify is not a standalone piece of software. It's actually the e-commerce infrastructure, and most importantly, we believe it has the data. That is the most important value add. So if anything, we think Shopify is actually controlled in one of the most important data gateway that's going to be fed into all the AI model at this point. So they do have advantage at this point.
And can you see them are they using that data already, or can you see them using that data as something to sell, or will they not sell that?
It's still too early to talk about monetization. That's why the company sounds a little bit hesitant when talking about how they're going to make money. But right now, yes, they are using data. They have a product called Shopify Catalog. Basically, if your merchant want to use ChatGPT or Gemini as a sales channel, you can sign up, put your product onto the catalog, and that's going to help the ChatGPT or Gemini to capture your product from there. So that's how they're using data at this point.
And are there any challengers to Shopify right now for e-commerce?
Not at this point. There used to be some smaller players a couple of years ago, but as Shopify built this well-rounded ecosystem around e-commerce, they're doing payment, fulfillment, and all the back-end solutions. We think Shopify is still the number one players outside the marketplace like Amazon.
And so with essentially kind of that out of the way, what are any potential headwinds that you could see? And going the other way, some tailwinds.
Yes, starting with the headwinds, it's not necessarily on Shopify, it's more of the continuation of this narrative that AI is killing software. We're reiterating our view that Shopify is not going to become a victim. If anything, is actually the beneficiary. And in terms of your question on tailwinds, we think we're going to see continued execution from the company that's going to help them to drive another round of valuation re-rating to rebound.
And are they spending a lot on AI? We hear about the numbers being bandied about as companies are developing AI, but are they spending a lot on buying it and implementing it, or does it feel like that's in control?
In my view, I think the company has a pretty much balanced approach. That's why if you look at the Q1 guidance as well as the Q4 actual performance, we're actually pleasantly surprised the company we're still able to report a strong profitability and metrics at this point. So I don't think it's gonna totally alter the landscape in terms of their margin, their free cash flow profile. But yes, they are investing, but in a very measured approach.
So essentially, just a lot of optimism for it then.
Yes, that's right.
Okay, John, thank you very much for joining us today. We appreciate it.
Thank you for your questions.
Okay, John Shao is equity analyst at TD Cowen. And we can take a quick look at the markets before we go. We've got about 30 seconds to wrap up the day. I don't think you're going to want to see them. It's been a rough day for pretty much everyone around, Shopify included. We were showing you those numbers, but the TSX is coming back a little bit. At one point, it was down by more than 2%. It is off, though, about 1.75%. We were seeing sell-off when I took a look earlier. It was most of the sectors were taking a hit right now. The only ones in the green were utilities, consumer staples, and comms. Info right now, the tech index, it is down by 6.6%. A lot of that dragged down by Shopify. South of the border, quick look at that before we go. And it's a similar situation. They're coming back a little bit, but they're still off. S&P 500 down by more than a point. Dow Jones nearly a point, and the NASDAQ at 1 point off close to 2, and now it's off by about 1.5%. Again, being dragged down by a lot of tech. That wraps up this edition of Trading Day. I'm Roger Peterson. Thanks very much for joining us. Have yourself a great afternoon.